Good afternoon, ladies and gentlemen. Good afternoon, ladies and gentlemen, and welcome to this webinar on financial instruments. We're very thankful for the kind of feedback that we've got for our effort. This is the 7th webinar of the series. We've already delivered 6 webinars on IFRSs. The project was to deliver a total of 40 hours of learning purely on IFRSs. We've got 4 more sessions left, including today's session, and from here onwards, there'll be 3 sessions on financial instruments, and there'll be a 4th session on taxes. So that's the plan. I think, let me say, this has been a phenomenal experience because the kind of feedback that we've received, the kind of participation level, the kind of interest people have shown in running these webinars, in attending these webinars, that has been very, very phenomenal. And from our side, it has been equally engaging, equally rewarding when we see such big numbers participating, when we see people interacting so much, asking so many questions. And that's exactly what the spirit of conducting these CPD events is on the webinars is. I'm very thankful to Mr. Mohammed Abu Bakr. He's taken a lot of his precious time out. His company is on the rollout of a very big project, yet he has been able to take out time every Friday and Saturday for the past 4 weeks and conducting these webinars. These sessions will continue to the 28th of January. That's last session will be the 28th. And after that, we have a lot of demand, other topics. For example, there was one on consolidations.
Yes.
So we're planning that. Plus, there's a lot of interest on taxes. We're planning that as well. There are sessions on Microsoft Excel business intelligence. That is something that we're going to offer as well. So I think by March we are all jam-packed with different webinars, different sessions. Without further ado, I am going to hand over to Mr. Mohammed Abu Bakr, but before that, just a few housekeeping rules. Since there are a lot of participants in the webinar, we will advise you to keep writing down your questions on a notepad. Just as there is a question and answer break, that is the time when you should try to type in your question. We will make an announcement during the question and answer break. That is the time when you should type your questions in. This will help us in making sure that each and every question that is raised is also answered. If you're typing in your questions in between, that makes it difficult for us to keep a track of all the questions. So I appreciate if you can keep noting down your questions, and just as there's a question and answer break, we'll give you a cue and you can start typing in your questions. Number 2, the certificates. I mean, there were some individuals who were asking me about the certificates of the previous session. Let me tell you, I mean, this was the revenue recognition session. So let me tell you that the certificates will just be handed out in a little while. However, the recordings have all been uploaded already, and they are on Vimeo.com as well as on our GoToWebinar channel. And we've noticed that there are people who are frequently looking at those videos as well, which is an excellent resource for some people who've probably missed it or wanted to repeat some part of the training. It's an excellent resource. So I think with that, I'll hand over to Mr. Mohammed Abu Bakr. I'm looking forward to a very, very interactive today's session as well, and the sessions to come. Your handouts for today's session have been uploaded on GoToWebinar. So if you look at the GoToWebinar window, the section under handouts says 3 of 5. So there are 3 handouts that have been uploaded. You can download these handouts from there. There are a few individuals who are insisting on receiving these handouts through email. So just as the webinar begins, I will send out an email to all participants, containing these handouts also. So best of luck. I'm sure today's session is going to be equally interactive. I now hand over to Mr. Mohammed.
Thank you, Mr. Haroon. Assalamu alaikum and good afternoon, everyone. And in today's session, we shall be covering a number of standards, of course, related to Assalamu alaikum, good afternoon, and first of all, let me introduce myself very briefly for those people who joined for this session only. I'm a fellow member of ACCA and associate member of Institute of Chartered Accountant of Pakistan, and I'm a partner of Baker Tilly Mahmood Idris Qamar, word number 8. I have a diversified experience of 13 years of performing leading roles in practice area of audit and assurance, business advisory, not only in Pakistan, but also in the Republic of Yemen and Republic of Mauritius.
So, yes. I'm not able to hear whatever I said, so can I wait? You repeat?
Yes, please.
Sorry for this interruption again. I realized that people were not able to hear me when I was talking earlier. So I'll very quickly repeat what I said. I welcome all of you to this seventh webinar, right, on this series of IFRSs and ISs A to Z. This is the 7th webinar, and there are 4 more, including today's. There are 4 more to go. 3 of these are going to be on the
financial instruments,
and
IFRS 13, yes.
Yeah, and the last one is going to be on
income taxes, yes.
So we've received a phenomenal response from all of you. Excellent participation, excellent interactive sessions, lots of questioning, which is an indication to us that these sessions are appreciated and people take these very positively. I must tell you that these sessions that we are running, this IFRS series, was run all across Middle East, North Africa and South Asia region. There were members, majority from Pakistan, but a big percentage of members attending it from Middle East, a big percentage of members attending it from Sri Lanka and Bangladesh. And in addition to that, people from outside this region also, because I know there are some ACCA members who are based in Australia who are attending this, and they're finding it very useful. So thank you very much for your appreciation, for taking time out, attending these, for making it interactive. This actually is the reward that we were looking forward to when we were running these sessions. Some housekeeping for today's session. I'd appreciate if you can take down your questions on a notepad. Please keep a notepad with you. Keep noting down your questions there. We are going to frequently announce question and answer breaks. So just as a question and answer break is announced, I'd appreciate if you can take out your questions, quickly type them in the question and answer box. The reason why we suggest this process to be followed, because this will help us keep a track of each and every question. Those questions that are put up during the session when Mr. Abu Bakr is conducting questions, right? They're asked a little in advance, and probably the content of the webinar automatically covers it, so there's no point in asking those questions. So let Mr. Abu Bakr complete his part, and then when the question and answer break is announced, that is when the questions should come in. And like I said, we will make sure that each and every question that way is answered. Just a quick announcement about the certificates of the previous session. The certificates of the previous session on revenue recognition are just going to be rolled out during the session. So those who were in the previous session as well, they should receive an email. The handouts for today's session on financial instruments are available on this GoToWebinar. So if you look at the GoToWebinar dialog box, under handouts, it should say 3 of 5. Right? So please download the handouts from there. I have received some requests from some members, from some participants who want to receive these handouts through email also. So I'm going to shortly send out emails as well, just in case. Thank you very much. Please keep the session very interactive, because the level of interest, the number of questions put up is our indication that the webinar has been successful. People are taking interest, and it has delivered the value it's supposed to deliver. Thank you very much. I hand over once again to Mr. Muhammad Abu Bakr, who's going to run the session.
Okay, thank you, Mr. Haroon. Actually, I don't know where I lost, but anyway, Assalamu alaikum and good afternoon. And just very briefly, my profile. I'm a fellow member of Association of Chartered Certified Accountants and associate member of Institute of Chartered Accountant of Pakistan, and partner of Baker Tilly Mahmood Idris Qamar, World Number 8 here in Pakistan, looking after business advisory and ERP. I have a diversified post-qualification experience of about 13 years of performing leading roles in practice areas of audit, assurance, business advisory, not only in Pakistan, also in the Republic of Yemen and Republic of Mauritius. I have delivered trainings to professionals, including partners of 2 renowned firms of Mauritius, and I'm a visiting lecturer of CFP Group of Colleges, Pakistan, and BSc Associate Mauritius in Financial Reporting, Audit and Assurance Services, Corporate Governance, Risk and Control. I was also responsible for training of audit staff on IFRS while working with Ernst & Young as manager. And further, just to add on this, a couple of months ago, there was a publication named IFRS Application Guide that covers almost all standard that was published, and it was authored by me, and that is for intermediate to advanced level. So let's come to the webinar. Its contents will be: number 1, this will cover International Accounting Standard 32, International Financial Reporting Standard 9, hedging. Of course, hedging is a part of IFRS 9, though it is separately mentioned, but anyway, that is also a part of IFRS 9. Then at the end, International Financial Reporting Standard 30. See, this will be covered in 3 sessions, each of 4 hours. And in order to get most benefit out of this session, so you must have a notebook ready, and of course, when we will be going through all these standards, we may need to do certain calculations in order to understand the concept as we run the webinar. So it is better you must have notebook and pen ready with you. Be attentive, as I usually said, having toffees or chocolates can help, because so many concepts are tightly linked with each other. So a point may not be understandable if related earlier concept is not appreciated. Members and other professionals sitting in groups should not start commenting until the session ends. Otherwise, this will impair the hearing of others in the group. You can ask all questions. We will try to answer all questions, but if any question is not relevant to the aspect being discussed, that can be deferred or that can be asked later on as well. So we shall be covering substantially the financial instruments, but may not be 100%. And again, I'll repeat the topic which is being discussed, the aspect which we will discuss. Please be relevant when asking your question. In the start, maybe I'll be asking you to ask questions more frequently, because today's session will be a base for tomorrow's session and the session to come. So it is better that whatever I convey to you, please take them very seriously. Okay. Another thing, we shall be discussing it in a practical manner. In other words, I want to say that though technical jargons cannot be avoided, but I'll try to keep them to the minimum. Of course, definitions are included, but I will try to explain them with the help of illustrations, examples, so that you could get the idea how to apply the guidelines given in the standard. So, okay, financial instruments. A financial instrument is a contract that gives rise to a financial asset of one entity and a financial liability or the equity instrument of another entity. See, with references to assets, liabilities, and equity instruments, the statement of financial position comes to mind. Further, the definition describes the financial instrument as a contract. So therefore, in a sense, financial instruments, financial liabilities, equity instruments, therefore, in a sense, financial assets, financial liabilities, and equity instruments are going to be pieces of paper. Financial instruments include primary instruments and derivative instruments that drives its value from the price or rate of an underlying item. See, if we discuss about the primary instruments, when an invoice is issued on the sale of goods on credit, the entity that has sold the goods has a financial asset. That is, the receivable is the financial asset, while the buyer has to account for a financial liability, the payable. The payable, when you sold a good, who sold the good will recognize a financial asset. In other words, trade receivable. And buyer will recognize a financial liability. In other words, the payable. Another example is when an entity raises finance by issuing equity shares. The entity that subscribes to the shares has a financial asset, an investment, while the issuer of the shares who raise the finance has to account for an equity instrument, equity share capital. A third example is when an entity raises finance by issuing bonds, debentures. The entity that subscribes to the bonds, that is, lends the money, has a financial asset. An entity, while the issuer of the bonds, that is the borrower who has raised the finance, has to account for the bonds as a financial liability. So a financial instrument is a contract that gives rise to a financial asset of one entity. Like if I just apply my examples to this definition with the help of this pen, see, when you sell goods to another entity, account receivable is the financial asset of the seller, whereas buyer will recognize the financial liability, and that is payable, that is trade payable. So this means a contract gives rise to financial asset of the seller and financial liability of another entity. Okay, now let's move to the another example. Another example is when an entity raises finance through the issuance of equity. So if you buy those shares, so this is your investment. This is your financial asset. If you have subscribed to those shares, this is your investment. This is financial asset. And on the other hand, the entity that issued the shares for them, this is their equity share capital, mean equity instrument, equity share capital. So for one party, this is financial asset, that is an investment, and for another party, this is equity instrument, equity share capital. Okay, let's see the third example. In third example, when an entity raises finance by issuing bonds, mean debentures, the entity that subscribes to the bond, mean lends the money, has a financial asset, mean an investment in the bond or debentures. One party who lends the money and the borrower who has raised the finance has to account for the bond as a financial liability. So this means a financial instrument is a contract which gives rise to a financial asset of one entity and financial liability or equity instrument of another entity. These were the examples of primary instruments. We can see few more examples. Like trade receivables. This is the financial asset of one liability who sold the shares, who sold the goods, as we discussed just in the earlier slide. And trade payables will be the financial liability of another entity. Investment in shares. Who invested in the shares, who bought these shares? This will be an investment for that entity. Whereas, who issued those shares, this will become the equity instrument for that other entity. Similarly, holder of redeemable preference shares, mean who subscribed to the preference shares. This is a financial asset for that party. Whereas, issuer of redeemable preference shares, non-equity shares, for him, this will be the financial liability. Similarly, loans receivables is a financial asset for one party, and loans payable will be the financial liability of another party. Similarly, bonds receivable, bonds payable. Investment in redeemable equity shares. Who invested in these shares? Who invested in these shares is basically this investment is a financial asset for that party. And who issued those shares? The party who issued those shares, these shares will be an equity instrument for that other party. We can have a few more examples like finance lease receivables. So these are the financial asset of one party, and for lesser, these will be the finance lease obligation. These will be the financial liabilities from the point of view of the lessor. Then before moving to the derivatives, we can look at a few more examples. Like here is a full list which will be sent to you. Like you can see that here. For a bank, deposit of cash with a bank. If you have a deposit of cash with a bank, this is your financial asset. This is your financial asset. And for bank, this is bank's financial liability. Deposits of the customers is a financial liability of the banker. So see, so far I am repeating it again and again. A financial instrument gives rise financial asset of one party and financial liability or equity instrument of another party. Then there are a few more examples here. See, a chain of contractual rights that will ultimately lead to the receipt of cash or to the acquisition of an equity instrument. The buyer of this right will have an investment. So this is financial asset for the buyer of this right. And a chain of contractual obligation that will ultimately lead to the payment of cash, and this will be the financial liability for the other party. But if this will ultimately lead to the issuance of the equity instrument, then for the other party, this will become the equity instrument. This means if there is a financial asset, on the other side, either it will be a financial liability or an equity instrument. So all of these were the examples of primary derivative instruments. So before moving further, just let me show you the definition again. Here, a financial asset is a contract that gives rise to the financial asset of one entity and a financial liability or equity instrument of another entity. And in these examples, we have seen financial instruments including primary instruments. So now let's have a look at few examples related to derivative instruments. Okay, these are the examples of derivative instruments. Buyers of in-the-money options. See, you might have heard the term in the money, at the money. You might have heard these terms. In the money options mean you will gain if you are able to exercise it immediately. If you are able to exercise an option immediately, and as a result you will gain from that activity, so that option will be termed as in the money. For example, the exercise price of an option is rupees 50. That by paying rupees 50 you can buy one share. Whereas in the open market the share is being traded at 75 rupees per share. So if you could exercise this option, so this means you will be able to buy that share at the rate of rupees 50. Whereas the same share can be sold immediately in the open market at the rate rupees 75 per share. So rupees 25 per share is your gain. So this means this option will be in the money. So for you this will be a financial asset, and the writer of this option who has given you this option, so this will be a financial liability for him. This will be a financial liability. Then is okay. Forward contracts standing at gain. Like if you have entered into an agreement to buy $100,000 at the rate of rupees. I am using Pakistan rate or close to Pakistan rate. Maybe today rate may be different, but close to Pakistan rate. For example, 105. You entered into an agreement to buy $100,000 at this rate. Whereas in open market, if you want to buy the same quantity, the rate is 110. So this means these terms and conditions are beneficial for you. So this forward contract will be termed as standing at gain. So this is your financial asset. And if in the open market the rate is like 99, say, whereas you have already entered into a forward contract whereby you will have to purchase $100,000 at the rate of 105 rupees per dollar, then this forward contract will be termed as standing at loss. So this will be your financial liability. So these are the examples. These are the examples of financial assets and financial liabilities. In brief, financial instrument is which give you present right, obligation to receive, deliver cash or another financial asset, and contractual in nature and not imposed by statutory requirements. So far, if you people have any question, please try to avoid technical jargon. I try to convey, though I have used technical jargon because those are unavoidable in certain situations, but I try to use them to their minimum. If you have any questions so far as the understanding what is financial asset, what is financial liability, and when financial instrument is that one part give rise to financial asset of one party and the financial liability or equity instrument of another party, I tried to explain this relationship and gave you a number of examples whereby you saw that financial asset of one party was becoming the financial liability or equity instrument of another party. If you are clear, okay, fine, but if you have question regarding this concept or the concept related to the derivatives, so please feel free to ask that question. By the time I move on, if you, Mr. Harun, if you do not have any question, okay, okay, please.
Zishan and there are more questions. Zishan is saying, can you give an example of non-financial instruments?
Yes, Mr. Zishan, I'm about to talk on non-financial instrument.
Fateh is asking, how can we differentiate between the financial instruments as papers only and the actual papers as papering only, and those on papers only as opposed to transaction values.
Fateh, can you please rephrase your question?
Hamza Shahzad is saying, what is the difference between redeemable non-equity shares and redeemable equity shares?
See, redeemable equity, non-equity shares mean that is your financial liability, and equity shares mean those are basically equity instruments. Anyway, we are going to discuss this difference in detail very shortly.
Amber Rafiq is asking, sir, could you please repeat the example of forward contract?
Okay. Amber, see, if we go to the last slide, I hope what I wrote should be there, but anyway, it is not there. Amber, see, forward contract is where you enter into an agreement with another party, and that agreement is binding agreement. For example, you enter into a forward contract to buy $100,000 at the rate of rupees, as I said, I think earlier, 105. I suppose I wrote earlier 105. So this is your forward contract. Now, if I want to see whether this forward contract is a financial asset for me or a financial liability, if this forward contract is standing at gain, then this is your financial asset, and automatically this will become the financial liability of the other party. On the other hand, if for you this contract stand at standing at loss, then this is financial liability for you, and of course for the other party this will become the financial asset. Now, when will this situation arise? See, you can buy something at 105, and if the rate in the open market is rupees 110, so this means you are in a position to buy $1 at 105, whereas in the open market it is being sold at 110. So this means your contract is at gain. And similarly, if in the open market the rate is, say, as I used earlier, I suppose I used 99. So in the open market you can buy this dollar at the rate of 99, but you have entered into a binding agreement with another party, which could be a bank, at the rate of 105. This means you will be buying each dollar at 105, whereas in the open market you can buy it at 99. This forward contract in this situation will become your financial liability, and of course the financial asset of the other party. Rabia, I hope it is clear. Sorry, it is clear.
I will move on. Salman Mehdi is asking, can preference shares / debentures be equity instruments?
Salman Mehdi, we are going to discuss this aspect in detail.
Sure. Very short. Amit Kumar is asking, right options in the financial asset?
Right option?
Is a financial asset?
Yes.
Tawseef Ahmed is asking, derivatives are those which derive value from some factors. How do you explain this?
Like, we can understand it with the help of a couple of examples. For example, options, currency options. Currency options derives their value from the underlying currency. Currency options derive from their value from the underlying currency. And there are few more examples of the derivative contracts. And few more examples are, for example, derivatives like forward contracts, like swaps. So if you enter into a swap, so that will drive its value from the related underlying item. Yes.
Zishan Hafiz is suggesting, can we avoid repeating previous examples so that we revise from when we are actually? You're very right, Zishan. But Zishan then says the presenter can decide, which questions to answer. So let me say that everybody participating has the right to ask questions. I'll appreciate if you do not request the presenter to repeat the previous topic. The recording of this presentation will be available on Vimeo, and if you want to repeat some content, you can of course go back and have a look at the recording. Thank you, Zishan. Sidra Haq is asking, buyer and money concept is confusing. Can you give another example, please?
Okay, forward contract. Because I am talking about the financial instruments. So if I talk about like some commodities, then this will, if that forward contract will be settled net in cash, then that will become the financial instrument. Sidra, can you specify where you are confused? For example, I have tried to elaborate it in more detail, but if you have any specific aspect to discuss, so please feel free to ask.
Rashid Khan is, sorry, can we move on?
Is Sidra said something?
Not yet.
Okay.
Rashid has sent a question through email.
Okay.
So Rashid, I guess you haven't attended our previous sessions. If you have to ask a question, use the dialog box and go to webinar. The questions dialog box and go to webinar. You don't have to send an email. I'm not actively checking my emails for questions. However, I just spotted yours. So Rashid's question is, can you please define derivatives? And you've done that. So
yes.
that's a repetition.
Yes. Anyway, I'll very quickly repeat this concept of derivatives. A derivative is a financial instrument that derives its value from the price or rate of an underlying item. For example, future contracts, similar to forward contracts, except that the contracts are standardized and traded on an exchange. What is future contract? I hope future contract is like if you go to a stock market. If you go to a stock market, and you may find two types of market within that market: spot market and future market. Future market. Here, you can buy or sell shares for immediate exchange of those shares. Whereas in future market, everything is agreed, except shares will be delivered at some point in the future, maybe after 1 month, 2 months, 3 months, depends the future period. If it's 1 month period, those will be delivered after 1 month. If it's 2 months period, future, then those will be delivered after 2 months. So the future prices will move according to the prices of the shares. According to the prices of the shares. So this means, if I go back to the definition, the underlying item is share. Underlying item is share. Okay? And the future price of those shares will be derived from the price of the shares in the spot market. I hope it should be clear. Okay.
Sidra is saying that buyer and seller concept, is it similar to agreement / contractual arrangement?
Yes.
Or an open market purchase?
Both. I mean, it's more or less piece of paper, but it is not compulsory that it should be in writing. But anyway, there will be two parties. Okay.
That's it.
So let's move further. It should allow me to move further. Okay. Then we can have a few examples of non-financial instruments. Non-financial instruments. See, inventories, property, plant and equipment, leased assets, intangible assets are not financial instruments because their control does not give rise to present right to receive cash or another financial asset. Because their control does not give rise to present right to receive cash or another financial asset. Let me make it simple. We have seen a list of financial assets. Of course, that will become the financial liability or equity instrument of another party. See, when those assets or liability will be settled, you will be receiving cash or other financial asset, or you will be paying cash or assuming financial liability or issuing equity instrument. Because in case of inventories, property, plant and equipment, leased asset and intangible assets, these assets does not give rise to a present right to receive cash or another financial asset. Prepaid expense, for example. Future benefit is the receipt of goods or services rather than the right to receive cash or another financial asset. Rather than this is the core principle, right to receive cash or another financial asset. Obligation to deliver cash or another financial asset. Similarly, deferred revenue and most warranty obligations are not financial, most, I am using the word most, deferred revenue and most warranty obligations. Deferred revenue, when you receive cash in advance from the customer, then you pass an entry, debit cash or bank, and credit deferred revenue. Deferred revenue and most warranty obligations are not financial liabilities because the outflow of economic benefits associated with them is the delivery of goods and services rather than the contractual obligation to pay cash or another financial asset. Rather than the contractual obligation to pay cash or another financial asset. Similarly, liabilities or assets that are not contractual in nature, such as income taxes that are created as a result of statutory requirements imposed by government, are not financial liabilities or financial assets because they are not contractual in nature. Accounting for income taxes is dealt in ISA 12, which will be discussed in our last session next week. Similarly, constructive obligations as defined in International Accounting Standard 37, provisions, contingent liabilities, and contingent assets do not arise from contracts and are not financial liabilities. Constructive obligations do not arise from contracts and are not financial liabilities. So these were the examples of assets which are not financial assets. So we have discussed the very basic concept. What is financial asset? What is financial liability? Of course, we know about the equity instrument. Now, in our discussion to come, we shall be discussing about these financial asset, financial liability, equity instrument, how to differentiate between asset and liability, how to account for financial asset, how to account for financial liability, how to account for equity instrument, initially, subsequently, and what about the implications of the impairment, and then various aspects related to the financial asset, financial liabilities, and equity instruments, which are basically financial instruments. So all our discussion will be around these 2-3 concepts. So let's start with IAS 32. IAS 32, International Accounting Standard 32, Financial Instruments Presentation. ISA 32 basically applies in the presentation of all types of financial instruments. Again, when I will say financial instruments, this means I am talking about either of financial asset or financial liability or equity instrument. Whether recognized or unrecognized, certain items are excluded, and those are interest in subsidiaries. Interest in subsidiaries, excuse me, interest in subsidiaries that will be treated as per International Accounting Standard 27. Interest in associates that will be treated in accordance with IAS 28. Interest in joint ventures that will be treated in accordance with IAS 31. Pensions and other post-retirement benefits, these will be treated in accordance with IAS 19. Then insurance contracts, then contracts for contingent consideration in a business combination, contracts that require a payment based on climatic, geological, or other physical variables, financial instruments, contracts, and obligations under share-based payments. So those financial instruments will be treated which fall under IFRS 2 according to IFRS 2. Okay. Then we can look at some important terms. Number one, equity instrument. Any contract that evidences a residual interest. So this is very important, especially in the recent year, it has become very important. Residual interest. After paying all liabilities, when a company is liquidated, after paying all the liabilities, whatever is left, so that is residual interest in the asset of the entity after deducting all of its liabilities. Then is second is fair value, the amount for which an asset could be exchanged or liability settled between knowledgeable willing parties in an arm's length transaction. We shall be exploring on this definition in a very simple way in IFRS 13 in the next section. Then is putable instrument, a financial instrument that gives the holder the right to put the instrument back to the issuer for cash or another financial asset, or is automatically put back to the issuer on occurrence of uncertain future event or the death or retirement of the instrument holder. Right to put mean right to sell the instrument, right to sell. The holder can sell this instrument back to the issuer. That instrument will be termed as putable instrument. Simply just recall your put option. Put option, if you just note it, it may be helpful in the coming discussion. Put option means if you are a buyer of this option, right to sell. And call option, if you are a buyer of this option, this means you have the right to buy. So any instrument which gives you the right to sell that instrument back to the issuer for cash or another financial asset, this is a financial instrument, but this will be termed as putable instrument. Putable instrument. Okay. So let's move to it's coming, fine. Learnings from this standard. See, first we will learn how to differentiate between debt and equity. In certain cases, it is very clear about an instrument, whether it is a debt or an equity. Like in case of ordinary share capital, that is equity. But in certain cases, it is difficult to rank that instrument as a debt or equity. This standard, at the end of this standard, we should be able to appreciate the difference between debt and equity. Second is how to segregate debt or equity components of compound hybrid instruments on initial recognition, like convertibles. We know that convertible debentures give you the right at the maturity date. The holder can receive the cash, or the holder can get the shares from the company, from the entity, issuing the convertible debentures. So this means these convertible debentures have two characteristics, those of debt as well as of equity. So this standard will teach us how to segregate the debt element within a convertible debentures and the equity element within that convertible debenture. In addition to few small other concepts, the main learning from International Accounting Standard 32 will be how to differentiate between debt and equity and how to segregate debt and equity components of compound hybrid instrument on initial recognition. Okay, first of all, let's have a discussion on the first element, and that is how to differentiate between debt and equity. The fundamental principle of International Accounting Standard 32 is that a financial instrument should be classified as either a financial liability or an equity instrument according to the substance of the contract, not its legal form. And the definition of financial liability and equity instrument is: financial liability is the contractual obligation to deliver cash or another financial asset. Contractual obligation to deliver cash. Equity is any contract that evidences a residual interest. We saw it earlier as well, I think, in the entity's assets after deducting all of its liabilities. But there are two exceptions, so I shall be discussing later on. Okay. From this principle. Okay, let's first of all discuss equity. Equity. Ordinary shares are of course equity. Ordinary shares where all the payments are at the discretion of the issuers are classified as equity of the issuers. Then preference shares required to be converted into a fixed number of ordinary shares on a fixed date or on the occurrence of an event that is certain to occur. That is certain to occur. Then these preference shares will be classified as equity. See, note here a few things. Required to be converted into the fixed number of ordinary shares, fixed date, occurrence of event which is certain. 1, 2, and 3. Occurrence of a certain event. So if all these three conditions are fulfilled, then that preference shares will be treated as equal. Right at the start of the lecture, we have seen that the redeemable preference equity shares. So in fact, those shares will be converted into a fixed number of ordinary shares at fixed date and on the occurrence of an event that is certain to occur. Where any of these criteria is not being met, that those preference shares will not be equity shares. Then is, please excuse me, because I am feeling dryness in my throat. Okay. Yes. Okay. Okay. Third one is a contract that will be settled by the entity receiving or delivering a fixed number of its own equity instruments in exchange for a fixed amount of cash or another financial asset is an equity instrument. This has been called fixed or fixed requirement. Okay, so then this will be treated as a equity instrument. Entity receiving or delivering fixed number. See again, fixed or fixed. principal is again coming here, fixed number of its own equity instrument in exchange for a fixed amount of cash or another financial asset is an equity instrument. So this contract will be termed as equity. Then let's move further. But please remember one thing, that right issue, when the price is denominated in a currency other than the entity's functional currency. Apparently, it seems perhaps fixed for fixed rule is not being followed. But standard says you will have to treat this as equity instrument. For example, right issue can still be classified as equity when the price is denominated in a currency other than the entity's functional currency. The price of the right is denominated in currencies other than the issuer's functional currency when the entity is listed in more than one jurisdiction or is required to do so by law or regulation. A fixed price in a non-functional currency would normally fill the fixed number of shares for a fixed amount of cash. Fixed number of shares, fixed number of shares for a fixed amount of cash so far as the functional currency is concerned, because you are issuing shares in a non-functional currency. See, for example, you are based in Pakistan, so your functional currency is say rupees. Your functional currency is rupees. If you are going to issue rights shares, and for those members who are non-resident, say you are required by law to price the right issue in terms of foreign currency. For example, you price them in dollar. Say in rupees the rate is like for right share is 500 per share. This is the excise price, and in dollars say $4.95 per share from the shareholders who are non-resident. See, though standard says treat it as an equity instrument, though apparently it seems that this principle, fixed number of shares, of course fixed number of shares, but so far as the fixed amount of cash in terms of functional currency is concerned, by the time you make this right issue, that might be changed as a result of change in the exchange rate of Pak rupee and the dollar. But you can say that this is an exception, but if we see in substance, so this is not an exception. So standard says that such right issue, though it is not fulfilling this criteria, but in fact these right shares represent the residual interest in the asset of the company. So this right issue will be treated as equity. Okay. Then is the debt. Okay, let's move to another slide. We'll be having two breaks. One at after 30 minutes, after 30 minutes, and the second break will be quarter to 6 as per Pakistan Standard Time, quarter to 6. In both breaks, we will be saying prayer. Okay. In first, of course, Asr, and in second, Maghrib. So this is equity. And if we go to the debt, if there is any variability in the amount of cash or on equity instrument, we have just seen the principle of fix for fix. So if there is a variability in the amount of cash or on equity instrument that will be delivered or received, then such a contract is a financial asset or liability as applicable. For example, where a contract requires the entity to deliver as many of the entities on equity instruments as are equal in value to a certain amount. As many, let me write here, as many equities, as many of the entities on equity shares as are equal to a certain amount. For example, say we say, okay, you will have to deliver shares equivalent to rupees 200,000. You will have to deliver the shares. Such number of shares which is equal to this value at some time in the future. The holder of the contract would be indifferent whether it received cash or shares to the value of that amount, because in either case he will be receiving 200,000, either in the form of shares or either in the form of cash. Thus, this contract will be treated as debt. If an entity issues preferred shares that pay a fixed rate of dividend, and that have a mandatory redemption feature at a future date, that you have to redeem them. The substance is that they are contractual obligation to deliver cash and therefore should be recognized as a liability. Then please note, preference shares that do not have a fixed maturity and where the issuer does not have a contractual obligation to make any payment are equity. See, even though the instruments are legally termed preference shares, they have different contractual terms, and one is financial liability and the other is equity. Okay, let's move to the next slide. Other factors that may result in an instrument being classified as debt are is redemption at the option of the instrument holder. If the answer is yes, then this will be a debt instrument. Similarly, is there a limited life to the instrument? If the answer to this question is yes, then again this is a debt instrument. Is redemption triggered by a future uncertain event that is beyond the control of both the holder and issuer of the instrument? So this is again a debt instrument if the answer to this question is yes. And are dividend non-discretionary? If dividends are non-discretionary, then again this is a debt. So this way you can differentiate between debt and equity. But once you classify it, when you will classify it? At the time of initial recognition. at the time of initial recognition, you will classify them either as debt or equity. Once classified, these will not be subsequently changed. This will not be subsequently changed on changed circumstances. Now let's discuss an exception. Though standard says it is an exception, but if we go to the very core of the concept, that is not an exception, that is basically being derived from the concept of residual interest. Okay. What is the exception? Exception is some financial instruments that currently meet the definition of a financial liability will be classified as equity because they represent the residual interest in the net asset of the entity. See, an instrument that meets the definition of a financial liability is classified as an equity instrument because it represents the residual interest in the net assets of the entity. For example, a putable financial instrument, provided they represents the residual interest in the net assets of the entity. Similarly, instruments or components of instrument that impose on the entity an obligation to deliver another party on pro rata basis the net assets of the entity only on consolidation. So again, these will be these financial instruments where they represent residual interest will be treated as equity instead of financial liability. Okay, before moving to the next aspect, so if we have any question related to this area, so please feel free to ask.
So I'm going to take you back to a question raised by Rehan Yusuf earlier. He wanted more examples of money in option and money at option.
Money at option. See, Mr. Rehan, see, there are three terms in fact. If I can use this slide, see if you just remember, options can be at the money, in the money, in the money, and out of the money. See, very simple. In the money, if you will make an immediate gain by exercising that option will be termed as in the money option. If you will make loss by exercising that option, that option will be termed as out of the money option. And similarly, if no profit, no loss, no profit and no loss, or simply you can say that break even, so then that option will be termed as at the. I hope it should be clear.
Yes, the next one is from Amir Tosif Ahmed. He's saying, if I bought goods or services and created liability to deliver cash or shares, would it be a financial instrument?
If you have bought goods or services and you will be paying, this is your payable, and you will be delivering cash or other asset in order to settle this liability, of course, this is your financial instrument.
Zishan Hafiz is asking, if we make a contract of sale, then it will not be financial asset. Please tell.
Contract of sale, this will not be financial, because under this agreement you will be delivering goods.
Tosif Ahmed is saying fair value definition is changed under fair value standard. or is it not changed in AS?
Mr. Tasif, you are very right. Remember one thing, anything related to the fair value, except few standards, like except IFRS 2, except net realizable value concept in ISA 2, and value in use concept in ISA 36. Wherever the word fair value appears, what is the fair value and how fair value is determined, that will be governed by International Financial Reporting Standard 13, which will be discussed in our coming sessions.
Muhammad is asking, my question is how we can differentiate between this situation where goods will be exchanged and other situations where the settlement will be just paying or receiving the net position of the instrument.
Fateh, if you will be settling something by netting, I mean you will be, instead of actually receiving the goods, you are going to settle it through netting the cash obligations or rights. So that will be your financial instrument. I'll give you an example. Hopefully that should make you clear. For example, you have entered into a future agreement to buy 10,000 tons of wheat, but we know that most of the future agreements are settled net in cash. So that's why, though this future agreement or future contract related to the wheat, but still it will be a financial instrument because this will be settled net in cash. Had it not been the case, this could not be treated as a financial instrument. Fateh, I hope it should be clear.
Okay, next is Sayyid Rehan Jamal saying, so this means that debt instrument will always have a limited life?
Debt instrument, no, could be in perpetuity as well, but most of the time, yes.
Rashid Akhtar Ali is saying there was voice distraction. Can you please explain the redemption trigger again? If it's a short answer, fine.
Okay, redemption trigger. Okay, you can go back very quickly. Who is this gentleman?
This is Rehan Jamal. Sayyid Rehan Jamal.
Rehan, we can go back very quickly if this will support us. Just okay, redemption trigger. Okay, fine. See, Rehan, redemption trigger is redemption triggered by a future uncertain event that is beyond the control of both holder and issuer of the instrument? If the answer is yes, then this is debt instrument. I hope it should be clear. Anyway, you can relook at the recording. Yes.
All right. Sayyid Rehan Jamal. He's saying, if financial instrument has perpetual life, is debt instrument then? I think this question is not clear, but I think it is. If financial instrument has perpetual life, then what will be the treatment?
Perpetual life. We are going to discuss that treatment. We have just started the financial instrument, so of course we'll be discussing all these things.
Okay.
And if this aspect is not covered, so please you can ask it.
Muhammad Iqbal, you will receive a certificate for your courses. Muhammad Ubaidullah Bashar is saying, explain exception with an example. Exception of financial liability which classified as equity.
See, any financial instrument, like I give you the example of putable financial instruments, putable financial instruments. If this instrument includes this aspect, represent residual interest in the net asset of the entity. So then this putable financial instrument, though the rest of the terms and condition will make it financial liability, but because of this, you will be treating it as a equity. You will be treating it as a equity. Yes, please.
Tosif Ahmed is asking, can you explain the last exception in IS 32?
Tosif, I just explained it. Anyway, another example is instruments or components, any other except this. Instruments or component of instrument that impose an entity an obligation to deliver another party on a pro rata basis, pro rata share of the net assets of the entity only on liquidation. Only on liquidation. Then that instrument will be treated as equity instead of liability. See, very simple, very simple. Any financial instrument, if it represents the residual interest, like if you say, if a term is included within an instrument that entity has an obligation to deliver on a pro rata share of the net assets of the entity on liquidation. So this will be treated as if that financial instrument represents the residual interest in the net asset of the entity. So that instrument will be treated as equity. Okay, next.
Rehan Yusuf, I hope your question is also answered. You were also looking for a practical example. You've given 2 examples.
Yes.
So again, Rehan Jamal is saying, can trade receivable be set off against trade payable? And if yes, then on what basis are we doing it?
Rehan, you are talking about setting off. Hopefully, this will appear in some slide very shortly.
Okay. Kashif Rashid is saying that death of holder could be an example of redemption trigger. Please explain.
Yes, yes, it could be example.
But he's saying, can you explain this?
So this is an example that if death of the holder is the is a trigger for the redemption. So this is an example for treating it as a financial liability.
Muhammad Salman is saying, can you please clarify the exception? It is still not clear.
Salman, see, if you have a financial instrument, very simple. If it includes a term, okay, if it includes a term like this, like that it entitles the holder to a pro rata share of the entity's net assets in the event of entity's liquidation. If that entity is liquidated and this instrument provides an option that this instrument holder will be able to claim a share from the net assets of the company, then that instrument will be treated as equity. Okay, move next. Any other question? Should I move further? Okay, fine. Okay, next is how to segregate debt and equity components of compound, hybrid instrument on initial recognition. See, if an entity issues a financial instrument that is hybrid compound, for example, convertible debentures, then the holder of such instrument has the option either to convert it into fixed number of equity shares or cash at the redemption. International Accounting Standard 32 requires that hybrid instruments should be recorded by separating the debt and equity element. First of all, debt element is calculated and the equity portion is residual value. For example, if a company received, for example, if a company received 3,000 on issuance of a compound instrument and the company calculated debt element as this is a very simple example. Of course, I have, I suppose, 3 examples, 2 simple and then 1 complex. 2 in these slides and 1 after starting IFRS 9, because for moving to a more complex illustration, we need to appreciate certain other concepts as well. Those concepts are covered under IFRS 9. So once we are through IFRS 9, once we are somewhere in the middle of IFRS 9, then I will be discussing this compound instrument again with reference to International Accounting Standard 32. Anyway, if you calculate that the debt instrument is 2460, as we have seen that IFRS International Accounting Standard 32 says that first of all determine debt element. Say how will it be calculated? We are going to discuss. Anyway, if you have calculated that out of this 3,000, 2460 is the debt element, then the balancing figure will be the equity element. Then the balancing figure will be the equity element, and that is the difference between 3,000 and 2460, which comes to 540. Okay, what will be the entry for this? Simply, you have received the cash or bank. Cash or bank will be debited with the full amount which we received, that is 3,000, and credit debt account, financial liability account or debt account 2460, and credit equity reserve for this convertible debenture 5420. So this is the principle, whole principle in summarized form. Like when you have a hybrid instrument or a compound instrument, first of all calculate the debt element and okay, sorry, I don't know where we broke, but anyway, I repeated. See, we were discussing the accounting treatment for the hybrid or compound instrument. First of all, calculate the debt element, and the equity element will be the balancing figure. For example, if you have issued a convertible debenture and you received cash 3,000, And when you calculated the debt element, it comes to 2460. The balancing figure, the difference between the actual cash receipt and the debt element, will be the equity element. Equity element will be 540. Entry will be debit cash bank account 3000, credit debt account 2460, and equity account 540. So as I said earlier, this is in a summary form, the treatment of the compound instrument. So let's discuss this concept in detail. Steps for segregation. Step number 1. Determine the future cash flows attached to the compound instrument, assuming cash will be paid on redemption. Assuming cash will be paid on redemption. Okay, this is an example. We shall be using this example to explain the steps involved in the segregation of debt and equity components of hybrid instrument. Example, if an entity issues 3,000 6% convertible debenture of rupees 1,000 each at par for a period of 3 years, which will be redeemed either at par or 250 shares against each convertible debenture. The market rate or effective rate of interest is 9%. Required. What are the future cash flows? Okay. First of all, we will determine what are the future cash flows attached to this hybrid instrument. See, future cash flows are one is interest. Interest is actual interest, which is when we multiply 3,000 with 6%, multiply 3,000 with 6%, this will give us 180 per year for 3 years, each year. Then redemption payment of rupees 3,000, redemption payment at the end of 3rd year. So this was our step number 1, in which what we did, we determined the future cash flows attached to the compound financial instrument. These are the future cash flows. Interest payments over a period of 3 years, 180 per year, and at the end of 3rd year, rupees 3,000, which is redemption payment. So these are the cash flows attached with this compound financial instrument. This is our step number 1. So we can have a break here, prayer break. Approximately, we'll be back after 10 to 15 minutes somewhere. So, okay.
15 minutes, yes.
Yes, we'll be back after 15 minutes from now. Mr. Harun, if you have any question, I can answer. Moving further.
Yes,
Provided.
There's a question about your calculation of 180. So,
Okay. So,
can you who's asked? Say, Jamal is saying, how do you calculate 180 per year? Just
Mr. Rehan,
my USP because
this is basically, see, 3,000, and each convertible has a face value of 1,000. So this give us 3 million in 2.6. So this is 180. This is 180. If you want me to mention the full amount, okay, this is the full amount. Because I did not mention here 1,000 here, so I remove 1,000 from here as well. And I hope it should be clear. Okay, let me raise this so that it's very clear. Rehan, is it clear? Rehan. Is it Rehan or something?
Say Rehan.
Say Rehan. See, this is the issue cost, and each convertible has there are rupees 1,000. Face value is 1,000. So this means when I multiply these two, this will give me the redemption payment. Redemption payment. Okay, now I will not go for 1,000. So this will give me the 3 million redemption payment at the end of third year. This is number 2. And number 1 is the interest payment at the end of each year. How should we calculate interest payment? Simply, interest payment will be calculated by multiplying 6% to 3 million. So this will give us 180,000 per year. 180,000 per year. Rehan, I hope it should be clear. This calculation at least should be clear so that we could move further. Mr. Arun, can you please check Mr. Rehan comments if he's okay, fine, or okay. So this is the first step where you calculate cash flows. Cash flows. We have calculated cash flows. Now the second step is discount future cash flows using the market rate or effective rate of interest. Market rate or effective rate of interest. Okay, so what is the effective rate of interest? 9%. So step number 2 is we shall be discounting it. Okay, year 1, year, and then here comes the cash flows, and then is the discount factor. And we shall be using effective interest rate, which is 9%, or market interest rate, and the last column will be this present value. At the end of year 1, there will be an outflow of interest payment of 180,000. Discount factor for first year will be 1 divided by 1.09. So this will give us 165,138. This is the present value. We calculate it by multiplying this cash outflow with this discount factor. Then in second year, 180,000 is the cash outflow again, which is interest payment. And the discount factor will be, I'm not using the table, just in case you have an interest rate or effective interest rate which is 9.5%. So you will not find that interest rate in the present value table. So it is better that you could refresh your discount factor calculation formula 151502. Then in third year, we will pay two amounts. One interest payment 180 plus 3 million. So at the end of third year, the total payment will be 3.18 million. And the discount factor for third year is 1.09 raised to power 3. So this gives us 24,543. When we add up all these figures, this will become 277, I hope, to 183. So remember, this is debt element. This is debt element. In first step, we determined the cash flows, future cash flows related to that instrument. Those were 180,000 interest payment for each year, and at the end of the third year, 3 million cash outflow on account of redemption payment. So when we discounted all these cash flows at the effective interest rate or the market rate, and we added all the discounted values, this will give us the debt element within this compound instrument. And the next step is the journal entry. So please remember this figure 2772183. Double entry will be debit cash or bank. We received 3 million and credit was financial liability mean debt account, as we just calculated 277 to 183, and the balancing figure will go to the equity reserve related to this compound instrument. Equity reserve related to this compound instrument. So this is the journal entry. The reasoning behind this approach is that an entity equity is its residual interest in its asset amount after deducting its liability. So this is the residual interest. So this way, this is basically two-step approach. First, determine the cash flows attached to that compound instrument, discount them using the effective interest rate or market rate of interest. Then you will add up those discounted values. This will give you debt element within the compound instrument, and the balancing figure, the remaining amount, will be the equity element of that compound instrument. If we have any question, please ask now. Do we have any question? Please.
Not right now, but this is the question answer break. So if you have any questions, please type your questions here. And we'll go one by one with all the questions.
And a pop-up question is coming up very shortly. So please be ready. Okay. I'll make you write because writing is. Okay, let's move further.
There are no questions here.
Okay, fine. Okay. Next is Graham Ghosh issues a 3% $200,000 2 years convertible bond at par. The effective rate of interest of the instrument is 8%. Effective rate of interest is 8%. Yes. Okay. Effective rate of interest is 8%. Okay. Graham Ghosh issues a 3% $200,000 2-year convertible bond at par. The effective rate of interest of the instrument is 8%. The terms of the convertible bond is that the holder of the bond on the redemption date has the option to convert the bond to equity shares at the rate of 10 shares with a nominal value of $1 per $100 debt rather than being repaid in cash. So this is another example of hybrid instrument. So let's calculate with the help of steps we just discussed. First pop-up question is, can you please write, Mr. Harun? First pop-up question is, please, pop-up question will be related to this illustration. So if you can do certain calculations before I ask pop-up question. Of course, my pop-up question will be related to step number 1 and step number 2. So it is better you should try to calculate the debt and equity element from this illustration because pop-up questions will be related to this illustration.
Yes, the question is.
Okay. Okay, the question is, calculate the total cash flows, attached with this compound instrument. Option 1, annual interest payment of 16,000 and capital repayment, this is in option 1, and capital repayment of 200,000.
So let me reduce it.
Okay, per annum interest payment 16,000
interest payment of 16,000 PA.
Okay. Plus 200,000 capital repayment.
Plus 200,000 capital repayment.
Option number 2.
So, yeah.
Option number 2. 6,000 interest payment per annum. You can use the same format, but replace 16,000 with 6,000 and 200,000 capital repayment. $200,000 capital repayment.
Yeah.
So these are the two options. Okay. Please pop up this question.
All right, the question appears on your screen now. I'll read out the question to you once again. Calculate the total cash flow attached to this compound instrument. Option 1 is interest payment of 16,000 per annum plus 200,000 capital repayment. Option 2 is interest payment of 6,000 per annum plus 200,000 capital repayment. You've got about 1 more minute to give your answers. About 30 seconds left. Please do your calculations quickly. Provide your answers. Okay, time is up. Alright. I'm now going to share the result on the screen. So, Mr. Abu Bakr, 40% of the people who responded, they said that the interest payment of 16,000 per annum plus 200,000 capital repayment. 60% said interest payment of 6,000 per annum plus 200,000 capital repayment.
60% are correct.
Okay.
60% are correct, but for those 40% who applied this 8% for the calculation of the interest payment, just for them, see the nominal interest rate, the coupon interest rate. This is the rate which is applied to the principal amount, to the nominal amount for the calculation of actual interest payments. This is effective interest rate. This will not be used for the calculation of the actual interest payment. Nominal or coupon rate of interest will be used for the calculation of actual. These are basically the actual cash payments, actual cash outflows. And those actual cash outflows will be calculated on the basis of nominal or coupon rate of interest, and 3% is the coupon rate of interest. When you say Graham Gosh issues a 3% 200,000 2-year convertible debenture, this 3% represents the coupon rate of interest. So that's why the people who answered like 6,000 per year as annual interest payment plus 200,000 capital repayment are correct. Okay. Now the next.
Just a few questions.
Okay, yes, please.
Munir Malik has given the right answer, but then he's asking, can be year-wise entry of this question when it converts into equity instead of being paid?
Who is this?
Munir Malik.
Munir, because we are in the process of step number 1 and step number 2, and you are asking about the last step. So please hold on. We shall be inshallah discussing. If we do not discuss this particular aspect, so please then you can ask that aspect. Otherwise, the other people will get confused because I am trying to focus on these 2 steps.
And we also wanted to tell us how to recognize the deferred tax on it. So will that be discussed?
In deferred tax, hopefully we shall be discussing that.
Sure. There are about 30% people who have given their answers, which means 70% people sitting on the webinar, about 315 people sitting.
Okay.
70% of them are not listening or not
Maybe they
participating in the poll questions. I think more people should participate.
So it is appreciated. It is recommended that everyone should participate, so that because this will provide us the real feedback, whether what we are saying being conveyed or not. So this will give us the real feedback. So it is recommended that everyone should participate.
Okay. One said they will vote for the marks, so that's acceptable.
Okay. So no, but okay. Here in Pakistan, I don't know. See, because
still he says he couldn't answer because he had gone for the marks. That's okay.
Okay, no problem. Okay, the next pop-up question, please write. The next pop-up question is.
Yes.
Should I speak? I hope most of the people will answer it, and rather I would expect that everyone should answer it. The question is, because I am assuming that whosoever is not participating, he understood this concept very well, so that's why he is not very active in answering this pop-up. But this time I would request that everyone should participate. Okay, the pop-up question is, the discount rate to be used to calculate the present value of future cash flows. Option 1, 8%. Option 2, 3%. Option 3, 10%. Yes.
Looking for it up. All right, the question goes on your screen right now. Question is the discount rate to be used to calculate the present value of future cash flows. 8%, 3%, or 10%. Again, about 30%.
Okay, I think still people have a chance to answer this.
Okay. How much time do you give? Half a minute more? Or
Okay, then half a minute more, so that they, at least those who are sleeping, they could answer.
So what should we do with the ones who are not responding? Do we assume that they're not present on the webinar?
Mr. Arun, this is purely your area.
Sure, madam.
Because I am also a member.
All right, I think time is up. Let's put up the scores. All right, 74% said 8%, 9% said 3%, and 16% said 10%.
9% said 3%.
Yeah.
And 74%
Yes.
said 8%. And 10%?
10% said 16%. So 16% said 10%.
Okay. 10%. See, 74% are correct.
Good. Excellent.
But please, these 16%, please, don't say like this, because I'm saying again and again, please, that effective interest rate, please note, those 9%, effective interest rate, in this case, effective interest rate is 8% or market rate, will be used for the calculation of present value. There is no 10%. I just threw it so that, so please. 3% is the coupon rate of interest. This will be used for the calculation of the actual interest payments. But for the calculation of the present value, you will be using 8%. Okay, let's calculate. There are just 2 years, so year, cash flows, discount factor, and then the present value. Year 1, cash flows amounted to 6,000. Year 2, cash flows amounted to interest payment plus capital repayment, mean 206,000. The discount rate for first year 1 divided by 1.08, and for the second year 1 divided by 1.08 raised to power 2. So this will give us for first year, and for the second year the amount will be 176,612. The total is 182,167. So please, this is the debt element. So the third pop-up question is, see, the journal entries will be the pop-up question related to the journal entry. Pop-up question is, cash and bank will be debited with 200,000. Fine. The question is, are we ready for the question? Okay. Yes, third. Okay. The amount to be credited to the debt account option 1, 176,612. 176,612. I mean this. 176,600. Option B, 182,167. 182,167. This is second. Third, 200,000. Okay, please.
Wait for the question to appear.
So when the question will appear, this screen will be lost. This will disappear.
Should I put it up?
Yes.
The amount to be credited, sorry. Oh. Sorry, I have pressed the wrong button again. Nobody could have voted. I have to type the question again. Just give me a minute. Amount to be credited to debt account. So amount to be credited to the first one was 176, 612, second was 182, 67, third was 100. So,
Yes.
save back. Okay, you have the question on your screen again. Amount to be credited to the debt account 176,612, 182,167, or 200,000. Okay, how much time do you think you should get?
1 minute. 1 minute is good enough because they need not to do any calculation. So everything is in front of them. They just need to decide because I have made all the calculations in front of them.
Okay.
Would you like to
And the time is up.
hide our webcam and stop sharing your webcam if you are doing so? No. Okay. Figures.
Share. Open the sharing pool results up. Alright, the results are on your screen. 18% thought that the answer is 176,612.
Hold on. 18%. Just let me.
It's right here if you want to see it here. You can all see it.
Okay.
So 18% said 176,612.
Okay.
77% said 182,167, and 5% said 200,000.
77% are correct. 77% are correct because we learned that debt element is the present value of the future cash flows. So the present value of the future cash flow is 182,167. So the debt element will be credited with this amount. Debt account will be credited with 182,167, and debit will be cash bank, that is 200,000, and equity element will be a balancing figure. So the balancing figure comes to 17833. So these are the calculations. This is the way you can segregate debt and equity elements in the compound instrument. Okay, let's so what we discussed, we mainly discussed number one, what is the financial instrument, and number of examples of financial instrument, financial assets, financial liability, equity instrument, and then about the derivative instrument and those instruments which are not basically financial instrument. Then we started International Accounting Standard 32, and there we tried to answer two specific aspects. Number one, how to determine whether an instrument is debt or a liability, and the second, how to segregate debt and equity components of hybrid or compound instruments. So these were the main discussions in the session, in this session so far. There are some other concept in International Accounting Standard 32. Treasury shares. If an entity reacquires its own equity instruments, those treasury shares shall be deducted from equity. No gain or loss shall be recognized in profit or loss on the purchase, sale, issue, or cancellation of any of an entity's own equity instrument. Mr. Fatih, you asked me a specific question related to International Accounting Standard 32. I sent you a very specific example, hopefully, which could explain your question. Okay, consideration paid or received shall be recognized directly in equity. Then there is a concept of offsetting. Any of the financial asset and liability which we discussed during this session should be offset, and the net amount reported when and only when an entity has a legally enforceable right to set off the amounts and intends either to settle on a net basis or to realize the asset and settle the liability simultaneously. If both these two conditions are being satisfied, then that asset and financial liability can be offset and presented in the statement of financial position on a net basis. Then disclosure, financial instrument disclosures. No problem, I'll answer. Just let me discuss this last slide, then I can answer. Financial instrument disclosures are in IFRS 7, financial instrument disclosure, and no longer in IAS 32. Second, the disclosure relating to treasury shares are in ISA 1, presentation of financial statement, and ISA 24, related parties for share repurchases from related parties. If you people have any question, please ask now before we move to the IFRS 9. But remember, I have left a part of International Accounting Standard 32 related to the compound instrument. That concept will be discussed somewhere during our discussion on IFRS 9, because without understanding a part of the IFRS 9, we cannot understand that aspect of the International Accounting Standard 32. So we will be revisiting ISA 32 related to the compound instrument, and there I will try to answer one of our respected member question regarding when these convertible will be either redeemed or entity will issue the shares. What will be the general entry for that? I will try to answer that question at that point in time as well. But if I forget, so please, of course that member is listening, so please remind me that at that point in time when I'll be closing our discussion on the compound instrument, I will be explaining that general entry. Okay.
Questions now. Munir Malik is asking what rate to be used if effective interest rate is not available.
Market rate of interest.
Muhammad Farhan is saying, unable to respond to the question. Farhan, you'll have to enable pop-ups on your browser. Only then you will be able to get these pop-up questions. You will have to enable pop-ups. So you have to go to your browser settings and enable that. Sayyid Arslan Gilani has given the answer here. Please give the answer when the pop-up question appears. Munir Malik is saying 17833 is the equity element, 182167 is the debt element. I think you got
yes,
answer.
he is
Yes, you're right.
might have
Munir Malik again saying show us sample financial statements of any live entity or refer the financial statements of any live entity from which we can see equity element of convertible bonds.
who is this?
Munir Malik.
Munir. Munir, you want to see the presentation, in fact. So tomorrow's session, either I will try to refer any financial statement, or I'll do it myself for you. That how it will be presented in the financial statement.
Imran Samad is saying, so you're asking very simple questions. I'm surprised that some people are saying that. That's all right. And I'm sure some people are joking also. That's all right. Musa Rayami is saying equity account 17833. It's financial liability or equity capital.
Again, please.
Is it financial liability?
Which one? Which one?
17833.
It's a financial liability.
Okay.
It's a financial liability.
Okay, so Sayyid Rehan Jamal is saying, please explain enforceable right.
Enforceable rights. The right which can be enforced through law. If you have a contract of setting off those assets and liability, so through that contract you can enforce your right through the operations of law. So that is enforceable right.
Imran Samad is saying, my question is about treasury shares. If those shares are taken at discount and or premium, then those would be straight away subtracted from equity?
Yes, that will remain in the equity. Yes, that will be subtracted from the equity, that will remain with the equity.
Munir Malik is saying, you may give an example of treasury shares in Pakistan.
See, he's commenting, or is he saying something?
He's suggesting that you may give an example of treasury shares in Pakistan. Anyways, let's move on. Tayyaba Samir is saying, in the Graham Booch example, could you please show the journal entries at the end of year 1 and year 2?
At the end of year 1 and at the end of year 2?
Yes. Graham Booch example.
Graham Booch example. I think in Graham Booch example, interest payment was 6,000. So cash or bank will be credited with this amount. And anyway, we are going to discuss this. And debit will be the profit and loss account with 16,000. I suppose, let me go back to that example. Okay, in this example, the interest payment is 6,000. So you will be crediting the cash with 6,000 and debiting the profit and loss account, meaning finance cost, will be calculated using effective interest rate. So this will give us 16,000. So the remaining balance will go to the debt account. But anyway, we are moving towards break, Maghrib break. But if you people have any question related, additional question related to this concept, we are going to discuss this entry and the similar entries under IFRS 9. So, any other question?
Yes, Kashif Rashid is saying treasury shares and shares buyback from controlling the shares price is the same concept. Please explain.
Controlling the
treasury shares and shares buyback for controlling the price.
Yes.
Is it the same concept?
Your own shares, these are termed as the treasury shares. So these will be deducted from the equity.
Malik is saying when will we cover IFRS 9?
After we will start IFRS 9 after Maghrib prayer, and we shall be having Maghrib prayer in a couple of minutes after answering if we have any other question.
Malik is hyperactive today. I mean, he's asking so many questions. His next question is, what is market rate? Can you please define it?
Market rate, which is prevailing in the market of similar type, and that with the same terms and conditions.
Kirul Haq is saying if we have both market rate and effective rate of interest, then which one should be used?
Normally both are same. So we shall be using effective rate of interest, because effective rate of interest, though based on the market rate of interest, but that is relevant to that particular instrument.
Munir Malik again saying, is it possible to give an example of treasury shares in Pakistan? That's what he meant.
See, Munir, if any company in the Pakistan has bought back its own shares, that will become the treasury shares. That can be reissued any time in the future. Any company.
Munir Malik again saying, how equity element account will be closed once we pay the debt in year 2?
Munir, I said before that when we will be revisiting ISA 32 related to the compound instrument, I will inshallah answer this question as well. Because at this point in time, I just focused on 2-3 things. Number one, on differentiation between debt and equity element, and how to account for the compound instrument. So when we will be revisiting, of course, I'll be making the general entries for you here.
Munir Malik again, he said, when will we cover IAS 39?
IAS 39?
IAS 39, yes.
Munir, we shall be covering IFRS 9. We shall not be covering IAS 39. We shall not be covering.
Thumbs up, Munir. Thank you very much. Mr. Abu Bakr. More questions?
Yes.
Sayyid Rehan Jamal is saying, in unquoted debt securities, if effective rate is not mentioned, then what should be the rate used?
See, then simply it will be the IRR of all the relevant cash flows attached to that debt. that will be the effective interest rate.
Malik says, thank you very much. Abdullah is asking, can you demonstrate any practical experience of treasury shares?
Practical experience of, no, sorry. Right now I don't have any example in my mind.
Sayyid Arsalan Gilani saying, why is the interest rate and market rate different? Is it because of risk?
See, when you issue a debt instrument, maybe at say 5%, but that is fixed for the whole life of the instrument, right from the start. Normally, when you issue a debt instrument at the fixed rate, but market keeps on changing. Maybe after 1 year, in the market, the rate may be higher or lower than the rate you used for the issuance of that debt instrument. So, because effective interest rate is based on the subsequently is based on the market. So that's why there are differences between the market rate and the non-market rate.
Sayyid Rehan Jamal is saying, please explain again. And his question was, in unquoted debt securities, if effective rate is not mentioned, then what rate should be used?
Sayyid Rehan, if we talk with reference to a practical example, then I answered that the IRR of all the cash flows attached to that instrument will be the effective interest rate. If you are talking with reference to a question given in a paper, of course, examiner should provide you effective interest rate, or he might have some other information, like he might have mentioned that market rate of interest is this much, then you can use that market rate of interest.
He wants this to be explained practically, so I think
Practically explained. I think he can rewatch the recording. So practically explained IRR of. So of course, when we will discuss IFRS 9, there I will try to explain this concept with the help of figures.
Okay, Krishna Casey is asking, if I am buying and selling with the same organization, then shall I offset while presenting an FP?
Krishna, if both criteria are met, then you can. I think we can go for...
No, just two more questions, then we take a break. Abdullah Wajid is asking, thank you, and he's saying, please include mark-to-market concept in your further webinars. Please take this as a request.
Mark-to-market. This is basically an American concept. Anyway, I will discuss with reference
in the future webinars. Yes. Sayyid Salam Bilani is saying, if the market rate changes in the future years, then do we have to revalue the debt and equity element in the financial statements?
We shall discuss in IFRS 9.
And that's about it. Thank you very much, Rahman, as well. Thank you. And we should now take a break for 15 minutes.
Yes.
And prayer break in Lahore. For people in other cities where it's not Maghrib time yet, you may say your prayers at the right time. However, we're taking a 15 minutes break, so by Pakistan time we should be back at 6 o'clock. UAE time we should be back at 5 o'clock. And see you again.
Welcome back. So now we shall start International Financial Reporting Standard 9, Financial Instrument. This standard has a effective date for annual periods beginning on or after 1st January 2018, with the earlier application permitted. First of all, some important terminologies. Amortized cost of a financial asset or a financial liability is the amount at which the financial asset or liability is measured at initial recognition minus principal repayments plus or minus the cumulative amortization of any difference between that initial amount and the maturity amount, and minus any write-off for impairment or uncollectability. So we shall understand this amortization cost with the help of an illustration. Next is the definition, effective interest rate. Effective interest method is a method of calculating the amortized cost of in financial instrument and of allocating the interest income or interest expense over the relevant period. The effective interest rate is the rate that exactly discounts estimated future cash payments. Before break, we were having many questions on this concept. See, effective interest rate is the rate that exactly discounts estimated future cash flows, payments or receipts through the expected life of the financial instrument to the net carrying amount of the financial asset or liability. Simply, this is basically the IRR related to the cash inflows and outflows attached with a debt instrument. This is simply a an IRR of the cash inflows and cash outflows attached with a debt instrument. Okay, equity instruments. Equity instruments. Equity instruments are initially measured at fair value less issue cost. When you normally issue your shares, so the cash you received less than issue cost. In many legal jurisdictions, when equity shares are issued, they are recorded at a nominal value, with the excess consideration received recorded in a share premium account and the issue cost being written off against the share premium. Subsequently, equity instruments are not remeasured. So this is a very simple principle, and we know, we all know this, that when you issue shares, simply debit cash, credit share capital with an amount equal to the multiple of number of shares issued into the face value. And any excessive amount will be credited to the share premium account after deduction of the issue cost. Okay. Next is financial liabilities. Financial liabilities, first of all, subsequent measurement. Normally, we discuss initial measurement first. Why I selected subsequent measurement? Because initial measurement depends on subsequent measurement. So there are two methods which can be used for subsequent measurement. One is fair value through profit or loss, and the other method is amortized cost. The other method is amortized cost. See, fair value through profit and loss, if you are holding that financial liability for trading, or if the entity so chooses. What does it mean? Like, upon initial recognition, if a financial liability is designated at fair value through profit and loss account, this is permitted when it results in more relevant information, because it eliminates or significantly reduces a measurement or recognition inconsistency, accounting mismatch. Maybe the relevant, maybe you have a compound instrument, or you might have an instrument in which the other portion, like in a hedging transaction, the other portion is being measured at fair value, and you consider that the related financial liability, if it is measured at amortized cost, this will result in the accounting mismatch, because another related instrument is being measured at fair value. Or it is a group of financial liabilities or financial asset and liabilities, and its performance is evaluated on a fair value basis in accordance with a documented risk management or investment strategy. Then that financial liability will be measured fair value through profit and loss. This means the default measurement is amortized cost. But if you want to measure a financial liability subsequently at fair value through profit or loss, then it should be held for trading, or the entity so chooses. When an entity will be choosing so, when this reduces a measurement or recognition inconsistency or accounting mismatch. Initial measurement. A financial liability will be initially measured at fair value if subsequently it will be measured at fair value through profit and loss, and fair value less issue cost if it will be subsequently measured at amortized cost. So this means initially what you will be doing, you will be deducting the issue cost from the fuel. This means initial measurement depends on subsequent measurement. If subsequently the financial liability will be measured using amortized cost, this means on initial measurement, fair value less issue cost, otherwise only the fair value. So let's see with the help of an illustration. A company raises finance by issuing 20,000, 6%. So this is the coupon rate. 6% 4-year loan notes on the first day of the current accounting period. The loan notes are issued at a discount of 10% and will be redeemed after 4 years at a premium of 1015. At a premium of 1015, the effective rate of interest is 10%. The issue costs were 1,000 required. Explain and illustrate. Explain and illustrate how the loan is accounted for in the financial statements of the company. See, we are assuming here that this financial liability will be subsequently measured at amortized cost. This financial liability will be subsequently measured at amortized cost. So, on initial measurement, at what amount this will be initially measured? We just learned fair value minus issue cost. So fair value is normally, in this case, is the cash received, which is 18,000 after 10% discount minus issue cost. So this asset will initially be measured at 17,000. This asset will initially be measured at 17,000. So in this case, normally the fair value is the net cash received. Net cash received after taking into account the discount. And because this will be subsequently measured at amortized cost, so we reduce the issue cost from this 18,000. So this financial liability will be measured at 17,000 and our initial entry should be bank or cash debit. Bank or cash debit with 17,000. Credit. Financial liability, or you can say debt account or financial liability. Both way can be named. This is a financial liability or loan notes. Okay, loan notes can be used or financial liability. Credit with 17,000. So this is the initial measurement. Subsequently, what happened? Subsequently, I have a separate page for this purpose. I should use that separate page. See, subsequently, like we prepare a small schedule of amortized cost, like year 1, what was the opening liability? Opening loan note, opening financial liability, one and the same thing. Opening balance of financial liability, that was 17,000. Profit and loss charge, mean finance cost, will be calculated at the rate of effective interest rate, which is in this case 12%. This 12% will be applied to this opening liability. So this will give us 2040. Cash paid. Cash will be paid, as we learned before Maghrib break when discussing the illustration related to the hybrid instrument, that cash will be paid on the basis of the coupon rate of interest. And here the coupon rate of interest is 6%. And that coupon rate will be applied to the face value of the loan note. So this is very important. Here we normally make a mistake. See, effective interest rate will be applied to this initially measured amount, whereas the amount paid on account of interest will be calculated by using the coupon rate of interest, and this coupon rate of interest will be multiplied to the face value of the financial liability. So this will be the amount which is the cash paid. Okay, now what will be the closing liability? Closing financial liability. 17,000, and this is the increase in this liability, 2040, and this much you have paid. So this plus this minus this, so your closing liability will become 17,840. If we just try to understand it with the help of, if we just try to understand it with the help of this definition, amortized cost. Amortized cost of a financial asset or financial liability is the amount. Okay, let's look at the amount. What was the amount? Here is the amount. Where is the amount? Is it gone? Or we used some other document? Okay, maybe we can use some other document. Where is the amount? Let me search where is the amount. I made the whole calculation here. Okay, let me check. I think that deleted the amount as well.
Were you writing in Word?
Yes, when I shifted from Word
PowerPoint slide
to PowerPoint, so
check the slides also.
No, that was not on the slide.
We have blank slide. There's a blank presentation.
But that is also removed because this is the problem with this. Otherwise, if we are using slide, okay, sorry, this is removed anyway. You might have with you the figures like at the end of first year. At the end of first year, the amount was 17,840. The financial is initially measured at the minus principal. See, if we go by exactly with the definition, so 17,000 was the initial recognition, was initially measured, minus principal repayment. What was the principal repayment? In fact, here is no principal repayment. Why? Because your interest charge was 2040, calculated by multiplying 17,000 with effective interest rate. But in fact, you have paid in the form of interest payment 1,200. So your payment does not even cover your finance charge. Had you paid more than this amount, the excess could have been treated as a principal repayment. Here in this particular case, there is no principal repayment. So plus or minus the cumulative amortization of any difference between the initial amount and the maturity, and minus any write down. So this will give you the 87,840. This means your initial liability was 17,000, and with the passage of time, this liability was increased due to the passage of time in the form of finance income, and you have paid this much cash. So your amortized cost at the end of first year is 1780. So this is your amortized cost at the end of first year. What will be the entry for this? Debit. See, credit will be the cash. You paid the cash 1200, but in fact your finance charge calculated on the basis of effective interest rate, which will be debited to the profit and loss account, is 2050. The difference will go to the financial liability, and the difference is, I suppose, 840. You can see that initially it was 17,000, and this, when we credited 840, so this, the closing financial liability, the amortized cost at the year end is 17,840. Very simple way. You might have not appreciated fully the wording of this definition, but the concept is very simple. See, you recognized this liability at 17,000, which is the cash received minus mean fair value minus issue cost. Then at the end of first year, you added within this liability the finance charge. This is the way you can calculate the amortized cost minus cash paid during the, in whatever form, like you have paid in this case related to interest payment. So this gives you the closing liability at amortized cost. This is the concept of the amortized cost. So if we have any question before I move to the next year, second, third and fourth year, and further into this concept. So if you people have any question related to the concept discussed about amortized cost, please feel free to ask. Okay, so I can go to the next. Year very quickly. I can mention here. So I will try to write everything here in one go. So I'll not be able to come back to see it again, because I have just noted that when I move to the PowerPoint, so the material written on this document file is deleted. So anyway, year one. So the table will be, if we here opening liability, finance charge at the rate of 12%, which is effective interest rate, cash paid in this case, and in all cases coupon rate of interest multiplied with the face value of that loan note or debt, and this is the closing liability, and this is the amortized cost. If we say A, this is B, this is C, so this will become A plus B minus C. A plus B minus C. Year 1, year 2, year 3, and year 4. Year opening balance was, we just calculated initial payment 17,000, and finance charge was 2040. 1200 was the cash payment. So this will give us 17840. And 17840 will be the opening amortized cost. Again, we applied 12% to the 17840. So this will give us 2141. Again, we paid the same amount, and the closing liability at amortized cost will become, and then this will become the opening balance 781, and when we apply 12% to this amount, this will give us 2254. Again, we have paid the same amount at the end of the year, so our closing liability at amortized cost will become 19,000 this, and then this will become the opening balance 358. And in year 4 we have paid, okay, this is the finance charge, and how much we have paid? We have paid 1200 plus, instead of 20,000 we have paid 21015 with the addition of 1015, the premium. If you just go back to the question, so this will give you 0. There will be rounding difference. So this way for each year, like in year 1, credit cash, the difference between these two figures is, if we see, if we have another color, okay, red. The difference between these two is 840 in this case. In this case, in second year, 2141 minus 1200, this is 941, and in third year minus 1200, this is 1054, and here there is no difference in fact, because we have paid the whole amount. So in first year I have shown you the double entry. In second year the double entry will be finance charge, profit and loss account is debited with 2141, and credit cash we have paid, or bank through bank, if we have paid through bank, 1200, and the balancing figure will go to the financial liability, which is 941. This way you will be effecting your financial liability at the end of each year. Okay. So here you have paid. If we come here, okay, I think we'll have to go to the normal board in order to drag it down. The same entry for, this is for year 2, same entry for year 3, but in year 3, debit will be, I'm mentioning here with the blue, debit will be 2254, credit cash again 1200 in year 3, this is for year 3, and 1054. This will be for year 3. For year 4, credit cash with total, that is 1200 plus 21015, which comes to 21015, which comes to 22215. Debit finance charge, profit and loss account 2380. The difference will reduce your financial liability, which is 19835. Debit financial liability. This will make this amount nil. So this is the whole picture when you account for financial liability subsequently at amortized cost. So this way you will be calculating amortized cost at the end of each year, simply opening plus finance charge for that particular year minus the actual cash payments. This will give you the amortized cost of that financial liability at the end of that particular year. Likewise, in second year, third year. And the amount of cash which you have paid will be credited. Finance charge is a profit and loss account item. Profit and loss will be debited. Any balancing figure will be either debited or credited to the financial liability. Okay. If there is a need to change it from here to normal. Okay, let's move back to, we discuss this and we discuss this. We were on this illustration. In case we are subsequently measuring our financial liability using amortized cost, and there are changes in the terms and condition of financial liability, then the balance of financial liability will be remeasured by applying the original effective interest rate on the revised future cash flows. The difference between the existing financial liability and the revised financial liability will be charged to the profit and loss account. Now we are moving a step ahead and we are moving into a practical situation. For example, you have a loan note. You have obtained a loan from a bank and everything is going fine, and you have recognized that loan subsequently at amortized cost, maybe after 2 years or after 3 years. There are changes in the terms and condition of that particular loan. So the treatment will be, you will be remeasuring from the date of change. You will be remeasuring the financial liability using the effective interest rate. How will it be done? From the date of change, you will be calculating the present value of the future cash flows using the effective interest rate. And the difference between this revised value and the original value as per original terms and condition, this difference will be charged to the profit and loss. So let's understand this concept with the help of an illustration. Hopefully this illustration is in front of you, it's available with you. If you have any question, Mr. Harun, we can answer that question. Okay, there are some questions. Okay.
So Dheer is asking, or they have to go. Munir is asking how to account for transaction costs, given examples in entry.
Transaction cost?
Yeah.
Okay. Actually, Mr. Munir, I made a compound entry. Anyway, if we separately do the entry for the issue cost, see what I did. I passed an entry on initial recognition, debit, cash, or bank with 17,000 and credited loan note or financial liability. I made this compound entry. So within this compound entry, this 1,000 is accounted for. Anyway, if I recognize issue cost separately, then the entry will be debit cash or bank account 18,000, because this is the cash which we received, credit financial liability, same financial liability I am writing here in abbreviation, 18,000. This is one entry, and the second entry is this one entry. Second entry will be debit financial liability account with 1,000. This is issue cost, credit cash or bank. Munir, I hope it should be clear. But I made compound entry instead of two separate entries. I made a compound entry. Okay, any other questions?
Yes, there are more questions. The question again by Munir is saying, if we issue convertible loan of 1,000 with transaction cost of 100, where transaction cost will be recorded?
Mr. Munir, we shall be inshallah discussing this specific point when we will be revisiting ISA 32 during this session.
Zaid bin Afaq is saying, sir, please also explain the working. If debt instrument is issued at premium and redeemable at par, what will be the liability in this case?
What will be the liability, for example? But this will not be a very perfect example, because when you change one thing, this 12% is affected. Anyway, we are ignoring this. Say if this loan note was issued at 10% premium, 10% premium, and were to be redeemed at discount of this much. So the initial entry, I'm just talking about the initial entry. Initial entry will be how much cash we have received in actual after deducting issue cost. That is 20,000 plus premium 10%, 2,000 mean minus issue cost. So this will give you the 21,000 and credit financial liability of 21,000. Of course, this will affect this 12%, but I am ignoring this. So this is the answer to your question. I hope it should be clear.
Nusa Al-Rayami is asking, can you send solution for illustration 1?
Yes, we have after today's session, I will request Mr. Harun to send it to you.
That's it.
Okay.
Questions so far.
Okay. So let's coming back to our original discussion. I was saying, please, like if you have obtained a loan, if you have obtained a loan from a bank, and there are after a couple of years, there are changes in the terms and conditions of that loan. So now, how will it be treated? How will it be treated? So we shall understand it with the help of this example. Here, on 1st January 2009, ZPL had obtained a bank loan of 100 million, at 10% premium. Now its premium is coming up. The interest was payable annually on 31st December and principal amount was repayable in 5 equal annual installments commencing from 31st December 2009. On 1st January 2011, the bank agreed to facilitate ZPL as follows. So now there are changes. What are the changes? These are the original terms and conditions. These are the original terms and conditions. Bank loan of 100 million. Interest was payable annually on 31st December. Interest was payable annually on 31st December. This is the principal amount. This is the timing of the payment of the interest. And principal amount was also being paid in 5 equal annual installments. 5 equal annual installment mean each year 20 million. In addition to the interest payment, they were required to pay under original terms and condition 20 million related to the principal amount. Okay. So up to this date, old terms and conditions were being followed. On 1st January 2011, the bank agreed to facilitate ZPL as follows. Balance amount of the principal. Now this is very important. Balance amount of the principal. What is the balance amount of the principal? That is 2009 was the first year. 2010 was the second year. Change is taking place in 2011. In this first year, a principal repayment amounted to 20 million was made. And likewise in 2010, another 20 million was paid. So at the start, on 1st January 2011, the balance amount of the principal was how much? 60 million. Would be paid at the end of the loan's term. Means from this date onward, no principal repayment will be made. The whole 60 million will be paid at the end of the loan term. Okay, next is with effect from 1st January, from the same date, interest would be paid at the rate of 10.5%. Originally it was being paid at the rate of 10%, but now it will be paid at the rate of 10.5%. So these are the new terms. Okay. The market rate of interest for similar debt is 10%. This means 10% is the effective interest rate required. Accounting treatment for the above financial liability. So now this is the case where you kept your financial liability, your loan at amortized, subsequently at amortized cost, but somewhere during the life of the loan, there are changes in the terms and conditions. So how this will be treated? In summary, if I tell you in summary before going into the calculation, we will calculate on 1st January 2011 the financial liability using the revised cash flows by applying the original effective interest rate. In this case, the original effective interest rate is 10%. So we will be able to calculate a financial liability. Now the existing financial liability based on the original terms, the difference between these two liabilities will be charged to the profit and loss account. Okay. Let's discuss this calculation. Okay. we can use, I hope these slides are with you, so I will not be able to come back here, otherwise my data will be deleted. Like here, you remember we wrote something on this page, but nothing is there. So we have a limitation, so I cannot come back to the question, but you people have a question with you. Okay. So here, see first year is 2009. First year is 2009. So let me keep the question in front of me and the material in front of me. Okay. Okay, now the question is in front of the solution is also in front of. Okay, year 2009. Opening liability. Opening liability is 100 million. Figures are in million. Here, finance charge calculated using effective interest rate, which is 10%. This 10% will be applied to this, so this will give us 10. Yes. Do we have any question? What? Sorry. खत्म करेंगे यहीं से शुरू करेंगे. Okay. Cash paid. Nominal interest rate, which is also 10%. That is 10 plus 20 million capital repayment. As I discussed, it is mentioned in the question that this 100 million will be repaid in 5 equal installments. So at the end of first year, you will be paying the interest on this opening balance using nominal. By chance, the nominal and the effective interest rate are the same. So this will give you the closing liability. Closing liability 80 million. All figures are in million. And this is the amortized cost. So 2010, 80 will be the opening balance. Finance charge at the rate of 10% will be 8. When we multiply this 10% nominal interest rate to this 80, so this will give us 8 plus 20 capital repayment. So 28 will be the total cash paid. So this will give us the 60. See, this 60 is financial liability. Financial liability immediately before change in terms. Immediately before change in terms. Now, there are changes in the terms. How many years are remaining? 3 years are remaining. So we need to recalculate this liability. We need to recalculate this liability. And this change is taking place at the start of 2011. Okay, let's calculate this. What I told you, that this will be future cash flows. What will be the future cash flows? In 2011, at the end of 2011, interest payment at the rate of 10.5%, and this 10.5% will be applicable to which figure? 60 million, which is outstanding. And in 2011, again the same amount. In 2012, this amount plus capital repayment. So this will give you into 60, this will give you 6.3, 6.3, 6.3 plus this will become 66.3. So these are the cash outflows over the remaining life of the asset. And these are the revised cash flows on 1st January 2011. We will be calculating the present value of these cash flows and using the original effective interest rate. What is the original effective interest rate? That was 10%, we know that. For first year, this will be the factor. For second year, this will be the factor. And for third year, this will be the factor. When we multiplied and added up all these factors, this will give us 60.746. When we have calculated and added up all these three figures, multiplied this factor with this, and then when we added up all these three figures, so this will give us 60.746. Now this is the revised value of that financial liability, which is 60. So at the start of 2011, the liability will become 60.746 instead of 60. The difference will be charged to the profit and loss account. The entry will be, because liability is increasing, debit profit and loss account with 0.746 and credit financial liability with 0.746. Thereafter, so you will continue the same way, like at the end of 2011, 10%, which is effective interest rate, will be multiplied to this. This will give us the finance charge. Cash paid will be based on the 60 million, which is the face value from bank point of view. Because these are the amortized cost from our point of view. By chance, the amortized cost and the bank principal value is the same, because in first 2 years, both rates were same. Normally, these are not same. So that's why the principal, as per the bank, and the principal, there could be a difference between these two. There could be a difference. Before I move further, what we discussed so far, if you people have any question, because we shall close today's session with this question, and we shall start tomorrow from here onward. So if you people have any question, please feel free to ask. Okay.
Rehan Jamal has asked for solution. We've already said that the solution will be email. Imran Samad is saying, sir, will you explain us the balance sheet presentation as well?
Who is this gentleman?
Imran Samad.
Imran, see, this closing liability is a balance sheet item, and this is the income statement charge, profit and loss portion charge, and this is the closing statement of financial position. But you will have to bifurcate it between the current and the long-term portion. Because in second year, you are settling an amount. So while showing this amount in the statement of financial position, you will have to segregate it between long-term portion and the current portion.
Sayyid Aslan Dilani is saying it should be 2013.
2013. Which one, Aslan? This. Thank you very much, Aslan. This is 12. This is 13. Thank you, Aslan.
Okay, thank you, Aslan. Next is Musa Rayami saying, from where do we get 20 for this example? Can you repeat?
Yes, Nusa, if I go back to the slide, then this will disappear. Anyway, slide is in front of you, so please keep it in front of you. I'll read it for you. See, Nusa, it is written here. Let me enlarge it. Okay. In the example, on 1st January, ZPL had obtained a bank loan of 100 million total loan at 10% per annum. The interest was payable annually on 31st December. This is also clear. Interest. Principal amount was repayable in 5 equal annual installments. 5 equal. No, sir. See, 5 equal. So for 100, 5 equal installment. Each installment will be 20 million. So at the end of first year, in addition to the interest payment, you repaid this principal installment as well. It is written in the question. It is the original terms and condition. But when the terms were revised, Nusa, I hope it should be clear. This 20 million is clear. Okay. Next question.
Someone saying, please advise about the financial statement risk in respect of financial instruments in terms of presentations and measurement.
Financial statement risk. Fateh, I would request that if we could be relevant to what we are discussing, so that will be more beneficial. These questions can be asked later on when we will be discussing more qualitative factors. Now we are just going through the basic material for learning how to account for the financial liability at amortized cost and if there are changes in the terms and conditions. Thank you, Fatih, for your cooperation.
Krishna is saying, in year 2009, does it require to pass accrued interest as well, or present value of future outflow?
2009, can you please repeat the question? Please repeat the question.
In the year 2009, does it require to pass accrued interest as well, or present value of future outflow?
So, Krishna, I could not fully appreciate your question. Anyway, I can mention here the double entry for 2009. Like you have paid this much cash, so you will credit the cash. I hope this will answer your question. So 30 million is the cash, and debit is the profit and loss account. Finance charge. We were naming it as a finance charge. Of course, this finance charge will go to the profit and loss account. So this will be debited with 10 million with this amount, finance charge, and the balancing figure will be debited to the financial liability, which is 20 million. So that's why this is reducing by 20 million. Krishna, I hope I answered your question.
Krishna, I'm going to unmute you. If you think this is, you've understood it, you could say yes or no. Otherwise, you could ask your question. I'm just going to unmute your computer. Okay, we can hear you now, Krishna. Krishna is saying yes. I think you will mute back. All right. There's another question from Kashif Rashid. He's saying it was really wonderful learning.
Thank you very much, Kashif.
Thanks, ACCA team and Mr. Abu Bakr.
Thank you very much. Thank you, Kashif.
And I think that's all about it. There are the two usual questions, 4 questions from my side.
Okay.
So let's very quickly answer these questions. The first one is about your feedback about today's session. So you should see the question on your screen. What's your feedback about today's session? Was it excellent, very useful, good, average, it was below average, or unacceptable? So please mark your answers. I want 100% grade. I mean 100% people voting. We just have a minute left, so please be very quick with your answers. Sidra is saying this was a wonderful session, amazing session. Thank you.
Thank you very much.
Javed is asking how will you get CPD form for this learning. Mevesh, you will receive a CPD certificate hopefully tomorrow of this session. Okay, I think we're given enough time. Close. Let me share the answers on your screen. Okay, 44% people said this was excellent. 49% people said this was very useful. And about 7% people said that this was good, which means about 90%.
Thank you very much. Thank you very much. So this really encourages us to put more effort in these sessions. So thank you very much for your compliments.
I think Mr. Abu Bakr's blood just increased by about 5-10 liters.
Yes, of course. Thank you very much.
And the last question is to find out from our how diverse our audience is. So where are you attending this session from? Are you from Pakistan, Middle East, Sri Lanka, Bangladesh, or any other country? Yasir Ammar Mahmood is saying thank you so much.
Yasir, you're welcome.
Muhammad Farhan is saying thank you very much. Thank you for attending, both of you.
Give me flash, I'll give you the answer for sending it to the business.
Muhammad Umar Liaquat is saying thanks for a great session. Muhammad Raza is saying thanks, wonderful session. Abdullah Wajid is saying please include mark to the market concept. Thank you. Waqas Naftar is saying thank you. Hussein Abdullah is saying thank you from Maldives.
Hussein, welcome.
Okay, close. I'm just going to share how diverse our audience was. So today we had 59% people from Pakistan, 34% from Middle East, and about 7% from other countries. We did have our friends from Bangladesh and Sri Lanka today, as many as we had before. Monica, thank you very much. Good comment. I must read it out. She's saying previously I was afraid of financial instruments, I guess, but today's session is just like a piece of cake.
Thank you very much.
Okay, Abnar Salan is saying Jazakallah khair. I enjoyed the session very much. Hamid Khan is saying thank you for all your efforts. Thank you for attending, friends. I think this was fantastic. Thank you all very, very much. And I think it's time to relax now. We've attended the first session on financial instruments successfully. Thank you very much for joining. Tomorrow's session, by the way, starts at 1 p.m. Pakistan time, 12 noon UAE time. Okay, and other countries should, respectively find out their time zones. So see you tomorrow, Pakistan time, 1 o'clock, and hopefully with the same enthusiasm and same interactive session tomorrow as well. Thank you very much. Thank you for all those people, and these messages are pouring in now. Thank you very much. There's Muhammad Shoaib from Morocco attending this.
Muhammad Shoaib, thank you very much. Thank you.
They are all thank you.
They are all because I am a member, they are members.
And the champion of the day is Munir Malik. He's pouring in this question. Thank you very much, Munir, if you're still listening. Thank you. Take care of yourselves. Take care and
Yeah.